Alright, so this is gonna be massive because I haven't seen anyone compiling all the SMC or ICT concepts, and I think I might be the first one to do it. So it's exciting and challenging for me at the same time. In this lecture, I will be compiling all the profitable ICT trading strategies together and make it a complete package for those who want to learn it from scratch and for those who wants to master ICT concepts. In short, this lecture is for all if they are beginners or if they are using ICT strategies for a while now. Another interesting thing is that ICT leaves some of the things undiscussed, as he says he has signed some non-disclosure agreement (NDA) and can't disclose some stuff. So I will be adding the much needed modifications to it to make it work even perfectly. Okay, so this will be the sequence of our lecture. First, we will discuss the basics like FVG, MSB. These are the terminologies that we will be using, and then we will discuss the strategies one by one, like IPDA, data ranges, and silver bullet, etc. But the thing about these basics is that they are as equally important as the strategies, because you can see that the first terminology is FVG, and here you can see there is a separate strategy for the FVG. So if you don't even know what FVG is, you cannot understand the strategy. Then there is SMT Divergence, AutoBlock. These are the two terminologies that we will be using in every one of the strategy except these trading models. Okay, so you have to understand the basics first. To understand the strategies, you have to understand the basics. And one more thing, in strategies, you just have to master a single strategy. It won't do any good to you if you learn each and every strategy. You can watch all of these and then you can select one which you think suits you and will work best for you. Then you have to master it and trade on it in a demo account. Then you can use it on a live account. Like it will take 10 or 15 days or even a month. If you are a slow learner, it can take more than a month to master these strategies. And then if you have any questions, you can ask me. So we will start the basics. Okay, the first terminology in the basics is FVG. So first I will draw it here and then I will show it in the chart. You can see that you get candles like this. Let me draw it first. This is a down closing candle. Then another, this can be on any time frame. Okay, this can be a 1 minute candle, this can be a 5 minute candle, or a daily, can be any candle. Okay, and then this one. So you can see that there is a gap between the top of this candle and the bottom of this candle. Here, this gap. Okay, this gap is called the fair value gap. It can even be in the upside. Let me draw it. Gaps can be formed anywhere. Okay, so this is the bullish case, and let me draw the wicks. Like if this is the wick, I haven't drawn it properly, but the gap between this upper wick and this downward wick, this is the fair value gap, and you can find it on every time frame and at multiple places. I will show you some of the FVGs here, and they are important. I will show you the importance here. You can see that the price has gone up into this fair value gap and then it has come down. So we will discuss it later, but this is called the fair value gaps. You can find it on multiple places. You can see this is also a fair value gap. This one is also a fair value gap. So you can find it everywhere. Okay, this is a 5-minute chart. Every candle is a 5-minute candle, so you can find it everywhere. Okay, this is the fair value gap. We will discuss it in detail in the fair value gap strategy. Okay, the next terminology is MSB, and then there is MSS. So people often confuses it. They are not the same thing. MSB and MSS are not the same thing. Okay, Church and MSS are the same thing. Okay, you might have seen some people using Church and some people use MSS. So these two are the same thing. So what is the difference between MSB and MSS? Okay, so MSB, we use MSB for higher time frames, okay, for higher time frames. Like if a price is going down for days or weeks, okay, and then it makes a higher high, then we say the market structure has broken, okay. And MSS, we use it for smaller time frames, for smaller time frames, okay. Like you see, if you are seeing a 5-minute chart, the price comes down, then if it makes a higher high, it is called MSS, okay, and it's a short-term break of this structure, then it can come down. So we use the term MSS for the smaller time frames, okay, and the this break is not that important. But MSB, we can use it on the daily time frame or the weekly time frame, and it shows a big reversal, okay, like it shows the change of the trend, okay. Let me show it on the chart. You can see that the price is going up, okay. Now if it breaks this area, this is called MSS, okay, on smaller time frame. This is a 5-minute chart, so if it closes below it, this is called MSS. Now if the price is going down or going up for weeks and then it makes a lower low, or if it's going up, if it's going down, it makes a higher high, then this is called the MSB. So this is the difference between MSS and MSB, okay. And MSS and church are the same things. Now what is the difference between BOS and MSS MSB? So BOS is the break of structure in the same direction, okay. Like you can see, if it makes a high, then if it makes another high, we say the break of structure has happened. So this shows the continuation, okay, like the direction hasn't changed and the price is still going up. Or if it's the price is going down and then it makes another low, so we say that the low has been broken or the break of structure has happened. I will show you the break of structures here. You can see break of structure happened here, okay. The price showed continuation, okay, it broke in the same direction. Here you can see there are multiple break of structures. This is the break of structure, then this is the break of structure. See, this shows a continuation. The price breaks in the same direction. Now if it changes the direction, like if it closes below it, we say it is the MSS, the market structure shift. I hope it makes sense, and now you will know the difference between these terminologies, okay. Now what is SSL and BSL? SSL means sell side liquidity and BSL stands for the buy side liquidity. But before discussing it, we will discuss what is liquidity, then we will come towards SSL and BSL. Okay, so what is liquidity? So in trading, price moves up or moves down to specific points called the liquidity levels or the liquidity points to execute some orders, because when the orders gets executed at those points, the value of that asset isn't affected, okay. So the market moves to certain points so that the orders are executed and the price or the value of that asset is not affected. So we will discuss it in detail in the liquidity sweep or turtle soup strategy, but I will briefly explain it here. Usually the liquidity level is the support or resistance level, or it can be the daily highs and lows or the weekly highs and lows. So you can see here, this is the resistance and the price is pumping from here again and again. So this is the support. So what the noobs do is they get into here, okay, and they put their stop losses below it because they think this is a support and the price will pump from here, and once if it closes below it, the market structure will get broken and it will go down. So what the market do is it hits the stop losses, okay, and then it moves up. So In this case, we say the sell side liquidity has been taken. Okay, SSL means sell side liquidity. So here we say the sell side liquidity has been taken. Now in the other case, let me show another example. So this is another liquidity level. So what people do is they tend to short from here because they think this is the resistance level, okay, and they put their stop losses above it. So once it goes above it, it hits their stop losses, okay. They put their stop losses above because they think once the price closes above it, it will go up, because then the market structure will be broken and the price has to go up. But what the market do is it hits their stop losses and then it goes down. So for market structure break, there are certain levels. You have to wait for certain levels, which we will discuss later on in some strategies, okay. So this was all about the liquidity. Now we will explain it in detail once we discuss the liquidity sweep strategy, but this was the brief explanation, the buy side liquidity and the sell side liquidity. Okay, once it hits your stop losses and goes up, we say the sell side liquidity has been taken, and once it hits your stop losses and then it goes down, we say the buy side liquidity has been taken. Okay, don't worry, we will discuss it in detail. The main thing is not the definition, but the main thing is spotting the points where the liquidity is. Okay, so we will discuss it later on. Now the next thing is SMT divergence. ICT in his Twitter space once said that he uses SMT divergences in 90% of his trades. So never ignore SMT divergence in your trades, okay. Now what is SMT divergence? So in trading, there are some pairs which are correlated and there are some pairs which are inversely related, like in Forex, the Euro and GBP. These are correlated pairs, so they are called SMT pairs. They are directly related. Like if the price of Euro goes up, the GBP also goes up. Then in crypto there is Bitcoin and Ethereum. They are also directly related, so they are SMT pairs. Now there is Euro and DXY. They are inversely related pairs, like if Euro goes up, DXY goes down. Similarly, in indices, there are Nasdaq and ES or SPX. They are directly related. Now, if you trade Bank Nifty, so its correlated pair is Nifty. Okay, so there are some pairs. I will give it in the description too. I will mention all these pairs. So how do you trade the SMT divergences? So I will show you the example of this Euro and GBP, okay. Let me show you an example of these divergences. Okay, so here you can see that Euro made a low here, and you can see that the GBP it didn't. So we get a divergence like this, a structure like this forms, and this divergence is bullish, okay. Once you get such divergences to the downside, this is bullish and the price then goes up. But there are some other things to it. We will discuss it in detail when we discuss this morning session strategy or a liquidity sweep strategy. So we will discuss SMT divergences in detail. This is the example. I discussed it briefly. Today I will give you one more example of the upside. Okay, so here you can see that Euro didn't make a high, okay, and the GBP made a high. So again, we got a divergence like this. So this is the bearish divergence, as we got this divergence on the top, so the price goes down. But it's not that simple. You have to wait for certain points for your entries, and we're gonna discuss it in detail later on. Okay, so the next thing, if when you trade ICT trading or ICT strategies, the next thing is the timing. Okay, you have to change your timing to New York. You can double tap on it, and You can see here you can change your timing to the New York. So you will use the New York time, okay, UTC New York, and later on I will tell you why the timing is important. So if you haven't changed the timings, you can change it now. Okay, so now this is important, order block. I will use the SMT divergences and order block concept a lot, okay? In every strategy, we will use these two terminologies. So what is order block? First, I will draw it here and then I will show you some examples. Let's suppose this is your support, okay? Or this is the liquidity level. This can either be the support or the liquidity level. Let me write it, support or important liquidity level. I will write LL, liquidity level. So let's suppose this is this level and the price is trading above it, up, down, and then suddenly the price goes down. Now what you have to do is look for a structure like this. It can either be here or it can either be below this line. So if a candle closes below it, it's a bearish candle. This order block I am explaining is bullish order block, okay? This candle closed below it. Now the next candle also closed below it. Then a candle comes and closes above this one, which is of course a green candle. So this candle closes above it. So here we say this is a bullish order block, down closing candle, and then the next candle closes above it. So this is order block, and uh, in order block we enter around here at the 0.5 fib level. Once the price goes down again to this level, then we enter into our longs, okay, and we put our stop losses below here. And by fib level, 0.5 fib level, I mean this candle, okay, 0.5 fib level of this candle. Sometimes it pumps from the top of this candle, sometimes it goes down to the 0.5 fib level. So what I do is I put some orders here and I put some order here as my stop loss is usually below this swing low, okay. And also the order block can form below this line. I have shown this is at this line, but it can form below it, okay. The same structure will form series of down closing candles, okay, and then this candle closes above it. Now you can find these order blocks on the 5 minute, you can find it on 15 minute, you can find it on 4 hour, you can find it on daily, okay. So I mean you can find it on smaller time frames and you can find it on higher time frames, okay. That was the example of bullish order block. Now let's suppose this is the resistance line or important liquidity level, okay. You will get bullish candles, okay, up closing candles. The price will go above this resistance, okay, and then suddenly the next candle will close below it, okay, a bearish candle. Again what we will do is you will either enter here or 0.5 fib level of that candle and you will put your stop loss above here and the price will go down. It can form around here too, okay. So it will form above the resistance or above this important liquidity level, and the bullish order block will form below this resistance or below this important liquidity level. So again I will discuss it in detail of how to enter into such trades. Now I will show you some example from this chart. Okay, so let me show you an example. This is now the 5 minute. You find an order block, a bullish or a bearish. Okay, so here you can see that there are a series of bullish candles, okay, and suddenly this candle closes below it, okay. You can see this candle closed below it, so the price goes up. In this case it went up to the body of this candle, not to the 0.5 fib level, and you can see then it came down. Now this is the example of the bullish order block. You can see that the price came down, okay, and then a candle closed above it, okay. Then the price again came down to the 0.5 fib level, like this is the 0.5 fib level. You can draw the 0.5 fib level like this, okay, from the top to the bottom. So this will be the half or 0.5 fib level of this candle, and once the price comes down, you will enter here, your stop loss will be below it, and you can see it gives you a good pump. So I will show you examples later on of high probability order blocks. Okay, so these were all the basics, all the terminologies that we will be using in these strategies. Okay, and in strategies, the first thing is always IPDA ranges. Whatever strategy you are using, you have to draw IPDA data ranges for yourself. Without these ranges, you cannot predict the liquidity levels, you cannot predict the support, you cannot predict the resistance. So in each one of this strategy, you have to draw IPDA data ranges. So next, I will discuss IPDA data ranges. Okay, so now that we have discussed all the basics, I hope it will be clear. Now we will come towards the strategies and we will discuss it one by one. Okay, but the thing about the strategies is that this IPDA data ranges, this is important for all of these strategies. Okay, we will use these data ranges in all of these trading strategies because it gives you an idea of the market, if it's in the premium or it's in the discount. The premium market is like I will draw it. Okay, so this is line. Now what is premium? The premium is that when the price is in a higher range and in premium range, you expect the shorts to work for you. Okay, like the price has gone up, and now if you see any short opportunity, that will be a valid opportunity to short, and your focus will mainly be on the shorts. Okay, not on the longs. And then below certain level, there is a discount range. Okay, and in discount range, you look for structures that are bullish because the price is already in the discount, and from here the price can pump. Now I am about to show you the IPDA data ranges, so I will show you the discount and the premium. So I will remove all these drawings from the chart. We will discuss how to draw or how to find out these IPDA data ranges. Okay, let me change the chart to daily. Okay, so what ICT do is ICT draws these ranges in the last 60 days. Okay, like now if it's 4th August, so he will draw it from almost the 4th of June. Okay, like the past 60 days. So now there are some weekends, so we will draw it from this level. To find out IPDA data ranges, what you do is you draw the 0.5 fib level from the bottom to this top. Okay, so this is the IPDA data ranges. Now this is the discount. Okay, this is the discount. Not this is the premium. Let me mark it red, but I will. Okay, so this is the premium, and below the 0.5, this is the discount zone. Let me mark it with the yellow. So here what you do is you look for any structure to short, and below this 0.5 fib line, this is the discount. So any structure which is bullish, you can enter into your longs. As you can see here, the price came down, and you can see yesterday it started pumping. So because it was in the discount, and if you shift to forward, there was an order block and it went up. So the IPDA data ranges gives you an idea of the market, if the market is in the premium or if it is in the discount. Now what you do is you have to draw some more fib levels. From the 0.5 fib level, you have to draw another one. Okay, now within the premium, again this is your discount and this is your premium. Okay, so it gives you a bit more sense of the market now. Okay, like if the price enters here, then you have to focus on your shorts. Okay, if the price goes down, you have to focus on the longs. Again, you will draw some lines here. Okay, now if you trade on smaller time frames like 15 minutes, okay, or 5 minutes, then you can draw some more lines for yourself. You can see we draw this line. So this was the premium, this was a discount, and you can see the price went up to the premium and a big dump. Now you can see the price came down to discount and a big pump. Again it happened here, price came down to discount and it pumped. So it gives you a good idea of the market. Here you can see the price went up to the premium, came down, again it went up to the premium, came down. So this is a very useful thing. You have to keep these lines on your charts. Whatever strategy you are using, it will give you an idea, okay? And you can draw even more fib levels within these ranges, okay? Like if you draw the 0.5 fib level from this point to this point, again this will be your premium. Let me mark it for you. This will be your premium, this will be your discount, and you can see the price went up and came down, went up again, it's going down. So it will already be clear, that gives you a good idea of where the market is headed next. Okay, now you can draw it here. The more lines you draw, the more it will help you. See, this is the premium, this is the discount, came down, went up, came down, went up, came down, went up. So I hope it's clear now. You have to draw it in the last 60 days, these ranges, and then what you do is you have to look for certain PD arrays within these levels. Like you have to draw some levels on the weekly, some levels on the daily, and some levels on the hourly or the 4 hour. Okay, like you can see this is the AutoBlock. So you have to mark this level for yourself, and you have to write here like 2 hour AutoBlock. So this is your 2 hour AutoBlock. Now let me shift to the daily. If there is anything on the daily, you can see there is the fair value gap of the daily. So this is another high time frame PD array. So you can write here daily FVG. So when the price comes down, you will have the idea of this fair value gap. You can see already the market has entered into the discount, and then the fair value gap is in the discount. So it gives you idea that the market is now bullish. Now you can see that this is the fair value gap, okay, and you can see that the market this is the premium zone. So this fair value gap is in the premium, so it's a confirmed trade. Like the price will go up into this fair value gap, and then you have to look for your shorts. You can see the price has gone down, so it will help you a lot, these PD arrays, okay, and these ranges. I hope it's clear now. If you have any questions, you can ask me. This was all about the IPD ranges. Now we will discuss the New York session strategy. Okay, New York morning session strategy. So again, the first step is drawing the IPD data ranges. This line that you can see, this is the 0.5 fib line. Above it is the premium, below it is the discount. Okay, so anything bullish here, we long it, okay, because it is the discount. Now in the start of my lecture in the basics, I told you to change the timings to New York UTC. So now this is the New York session and the timing is the New York UTC. So what you have to do is you have to draw a line at the 9:30 New York. Okay, this is your 9:30 New York, and ICT says this is your strategy for life. Okay, so what does he mean by strategy for life? So what he says is he says wait for the 9:30 a.m. and then if the price sweeps the recent lows or the yesterday equal lows like this one, if it sweeps this area, and then you get an order block here as I shown you in the start of my lecture, this is the 5 minutes, so you can get this AutoBlock on 1 minute or 3 minute. Okay. Also, one of the definition of the AutoBlock is a series of down closing candle and then an up closing candle. Okay, and you can see there is also a fair value game, so this is a high probability AutoBlock. It comes down, okay, and your stop loss will be here. So this is what he means by the New York morning session strategy. You have to wait for the sweep either on the upside or on the downside. Now you got the sweep of the previous day lows, okay, before the 9:30, the pre 9:30 lows, and then you got an order block, and on the retest you have to long. And one of the one of the reason that your bias is toward the upside is because this is in the discount. Okay, so anything bullish here, you will long here. So you can see if you long here, it gives you a good profit, and then what happens, it sweeps this high. Okay, this pre 9:30 a.m. high, this was the high, and now that you know, the price has entered into the premium. So anything bearish, and you will enter into your shorts. You can see there will be an order block on the 3 minute or 1 minute. Okay, a candle will close below the up closing candle, and then on the retest of the 0.5 fib level, something like this will form. I'm not shifting to the 1 minute or 3 minute because the whole chart will be disturbed. Okay, so you will enter into your shorts, and you can see it has come down. So ICT says this is gonna be your strategy for life. You have to draw this 9:30 a.m. and once you get the sweeps, you will enter into your shorts and into your longs. But the main thing again is the IPDA data range. If it's in the discount and it sweeps the lows, you have to enter into your long. Now, luckily or coincidentally, it has entered into the premium and it has also swept the pre 9:30 a.m. highs. Okay, so you will again enter into your shorts. So this is how it works. Okay, now you will find it every day. If not every day, you can find it on 2 to 3 days, but the range matters. Okay, if it's an important range like near the discount and the premium, then this strategy is gold. Okay, if it's a mid range somewhere in the discount or somewhere in the premium, then the strategy won't work for you because you have to wait for the price to go up into the premium and the discount. Okay, so it's better to trade this in the discount and the premium zones, not in the mid ranges. I hope it's clear. This was all about the New York morning session strategy. The stop loss is below the swing low. Okay, entry is at the order block, and you can target 15 pips, 20 pips. That depends on you. You can either target these highs. Okay, so taking profit is always important. I usually target 15 to 20 pips. I don't wait for the highs now. Previously I used to wait, but then I got stopped out at times. Okay, so now I use 15 to 20 pips. So that was all about New York morning session strategy. I hope it's clear. If you have any questions, you can ask me. Now we will discuss ICT structures that repeats exactly the same way every time. Okay, like there will be no difference. It repeats exactly the same way because these structures are according to some rules. Okay, like it's not just a coincidence. I will tell you why it repeats exactly the same way all the time. So usually it can happen on the 15 minutes, 1 hour, or any time frame, but my favorite setup is 4 hour. Okay, so this setup that I'm showing you right now, I trade it on the 4 hour. Okay, what happens in this model is that the price quickly goes up. Okay, so you get a quick move up, then we see consolidation for some time, and we get a higher high. Okay, then the price again moves up and down for some time, and then we get a lower low. Like here, you get the sweep of these highs, a higher high, then you get the sweep of these lows. Okay, so the sweep of the high and the sweep of the low. then what happens is that it suddenly pumps and it closes above here. Okay, so once it closes above this point, this is your confirmation, okay, that the price will retest the 0.5 fib level, okay, and it will pump. I will show you this structure on the chart also, but first you have to understand the structure of why it happens. You can see first it takes the buy side liquidity, then it takes the sell side liquidity. Here people think that the price has broken out and it will go up, and suddenly it starts going down, so it's also called turtle soup. Then again the price goes down, people think the price has broken down and it will go down even more, and suddenly it starts going up. So in this structure what you do is you should wait for a close above this point, okay, and then once it goes below the 0.5 fib level, this is where you have to enter, okay. And what usually happens is at this point there is usually fair value gap, okay. So you should put your entries in the last fair value gap. It might be on the 15-minute, it might be on the 3-minute, it might be on the 5 minutes. So your entry point should be the last fair value gap in this area, okay. Let's suppose the fair value gap is in this point, so your orders will be this at this point and your stop loss will be a bit wide. Your stop loss will be below this swing low, okay. The stop loss is usually wide because also the target is big, it's kind of a swing trade, so you should keep your stop loss wide. And I will show it pumps big. Now I will show you this example in this chart. You can see that we get a quick move up, then the price starts consolidation here and makes a higher high, okay. Here it made two higher highs, but it shouldn't concern us. It made a higher high, then the price came down again. You can see it made a lower low, so this is important. What first it took the buy side liquidity, okay, and then it took the sell side liquidity, okay, and then this was the last swing high before making this low. So once the price closes above it, that's the confirmation of the pump. Now what you have to do is you have to wait for the last fair value gap. So there are some fair value gaps, the price came down, okay? And the reason that you put your stop loss below it, because sometimes the price gives a wick, you can see here. So you should place a stop loss somewhere below this swing low so that your stop loss won't get hit. And you can see it gives you a big pump. It repeats every now and then. It forms on the Forex, it forms on the crypto, it forms on the indices. So this is a structure that you should remember. And right now I am seeing this chart on the Bitcoin. Okay, in Bitcoin such structure has formed and the Bitcoin will pump towards 32k. Okay, and now another structure which I called is inverted L pattern. Okay, inverted L pattern. This is a pattern that I use on smaller time frames. Okay, inverted L pattern, and I use it on smaller time frames for my scalp traders. Okay, now how is this pattern an inverted L? So you get a consolidation, then suddenly the price goes down. Okay, so that's why I say the inverted L. You get something like this. Okay, like this is consolidation 9, a drop. Okay, then what happens is again the price goes into the consolidation and again it goes down. Okay, now it's only valid if you have some fair value gaps previously on higher time frames or smaller time frames. Like if you have got some order blocks or fair value gaps in this area and you get something like this and the price goes down and it comes down to this order block or the fair value gap, then what you have to do is you have to wait for the price to go above it. Again the price will go down to 0.5 fib level. That's where you have to enter and you will target these highs. Okay, it will take these highs. Okay, now another point is that if this is a premium, okay, like if there is a line and this is the premium, usually what happens is it dumps straight down. Okay, so you have to be careful around this area, and you have to be quick in the taking the profits around this point. And if it's the premium and you get a bear structure, it usually do something like this, kind of a Judah swing. Okay, so you have to be aware of this. Now I will show you the example of this in euro chart. Okay, so here it is. Let me zoom it in. You can see that the price was consolidating in this area. Okay, then what happened? It came down. Okay, and then again the price entered to this consolidation, and again came down. Now if you go back, there is a fair value gap. Okay, and also there is order block. If I shift to higher time frames, you can check it by yourself. Okay, then what happened? It went up. Okay, it closed above it. Now as I said, the next step will be waiting for the 0.5 fib level. Once it comes down to 0.5 fib level, you should enter here and you will target these highs. Okay, you can see went up and then it quickly gone down. Okay, so you have to be careful at this area. So this was the example of the inverted L pattern. Also we got this on the GBP. Let me show you. Okay, so this is the GBP chart. You can see the price was consolidating here. Okay, then it came down. Again the price entered into the consolidation. Okay, again it came down. I gave this entry in my Facebook too, because you can see the price went up. Okay, it closed above, then it came down. Let me correct it. You can see it went up, came down, and then you can see the pump. Now it should go up like it came down, but it will again move up and it will take these highs, and then this is where I will close. Okay, I have already taken some profits, but I'm waiting, still waiting for this point. Okay, and my stop loss is at the entry point. So this is this inverted L pattern. I hope it's clear. Okay, so now we will discuss the third structure, and this structure usually forms at the top and the bottom. So in this structure, you get the sweep of the previous highs on the 4 hour. Okay, just like this. Okay, and then you get a close below the last swing low, and the price goes up to 0.5 fib level and it goes down. It usually forms at the top. This is one of the examples. You can see this was the high, then the highs were swept. If you shift to smaller time frames, you can see the price swept this high, and this was the last swing low. Okay, below forming this high, so the price came down. Okay, it closed below it, and when the price went up to 0.5 fib level, it came down. So this kind of structure usually forms at the top and at the bottom. I'm sure we will get a structure like this in the bottom too. You can see this is a daily time frame, but if you shift to smaller time frames like 4 hour, you will be able to see it. So here too something like this happens. Okay, it makes a low, the price goes up, it sweeps this low. Okay, and then it closes below this last swing high, and then here, and it goes straight up. So this kind of pattern, this usually forms at the top. Okay, at the bottom, and this one I showed you, this forms at the top. So I hope it will be clear. These were some trading models that I use. These two I use at the top and the bottom, and the other one for a big swing trade, and the inverted L pattern for my scalp trades. Okay, so now it's time for the most trending ICT strategy, which is the ICT silver bullet strategy. And I know a majority of you, almost 90% of you, are trading it the wrong way, because I have seen my friends and my family, they have blown their accounts due to this strategy because they don't know how to trade. They just find a fair value gap, they get an entry and get stop out. Okay, so in this lecture I will show you the right way of how to trade it. Okay, and one more thing, you cannot trade on the silver bullet strategy every day. Okay, it gives you a trade 1, 2 or 3 days in a week, okay? It won't give you a trade every day. So first we will discuss the basics. So in silver bullish strategy, you have to trade between a certain window. You have to trade between 3 to 4 a.m. New York time and 10 to 11 a.m. okay? You have to trade during this time, okay? And one more thing, enter during 3 to 4, okay? Enter during 3 to 4 and 10, let me write it, 10 to 11. But you don't have to exit, you don't have to exit during this window, okay? These are the three rules, okay? During this time period, like if you enter into your trade during 3 to 4 or 10 to 11, then you can wait for your target even if it's not after the 4 a.m, okay, or even if it's after 11 a.m. So remember this, what people do is they enter into their trades, and when they don't see a pump or a dump, they exit it because they think it's 4 a.m, so it's end of the silver bullet window, and they get out of their trades. But you don't have to do it. Once you get an entry, you can hold it even after the 4 a.m and 11 a.m, and the target should be 15 pips, okay? 15 pips for Forex and 10 pips for indices, okay? And you can keep the target of 15 pips for the crypto too. So these are the few rules, okay? You have to follow them. Now, what is silver bullet strategy? So in silver bullet strategy, you get a fair value gap during the 3 to 4 a.m and 10 to 11 a.m New York time, okay? I will show you some examples. You can see here, this is the fair value gap during 3 to 4 a.m window. This is the 3 a.m, okay, and this is the 4 a.m. Let me draw this line. Okay, so once you get a fair value gap during this time period, you have to enter into your trades. If it's a bullish FVG, you have to enter into your longs. If it's a bearish FVG, you have to enter into your shorts. This is the example of the bearish FVG. But remember, not every FVG is valid, okay? The reason people are losing their money in the silver bullet strategy because they think every fair value gap or every FVG is valid. Only few fair value gaps are valid, and I will show you which one are the valid ones, okay? So now we will discuss this one, why this is a valid FVG. A few days back I traded this one, okay, and I exited around here. So why is this a valid FVG? You can see that during this 3 to 4 a.m a high was made, okay, in the euro. This is euro, so in euro it took this buy side liquidity and a high was made. Now the correlated pair or the SMT pair, as we have already discussed in the start, is GBP. So you can see in GBP it didn't sweep this high, okay? So we got an SMT divergence like this, okay? This is called an SMT divergence, and this is a bearish divergence. So in silver bullet, you have to look for divergences on smaller time frames, either during the 3 to 4 a.m or 10 to 11 a.m, or you can also look at the divergences before that, okay? Like if there is this divergence and then it takes this liquidity, then you can look for uh, same divergences like this. If it don't sweep the liquidity, okay, the sell side, the buy side liquidity, and this pair sweeps it, then this is a bearish divergence. And then if you find a fair value gap, you can enter into a shorts like this, and you will have to put your stop losses around here, okay, above this swing high, okay, just above this swing high, and you can target 10 pips or 15 pips for Forex, okay? So the main hack or the main modification is the SMT divergence, okay? when there is no divergence, you don't have to trade the silver bullet, okay? Then it's not a valid fair value gap. Only the fair value gaps after the divergence are valid. So this is pretty much all about the silver bullet. If you have any questions, you can ask me, but this is all about the silver bullet. This is my strategy to use to trade on the silver bullet. I look for these bearish and bullish divergences, okay? I hope it makes sense. The next strategy we are going to discuss is the liquidity sweep or the turtle soup strategy, okay? The important thing or the main thing about this strategy is that through this strategy, you can find out if a market structure break or if a market structure shift is a valid break or it's just a fake move, okay? Like you can see this move, it has come down, okay? You might think that the support has broken and it will go down, but then it turns out that this was a fake move. So with the help of liquidity sweep strategy or the turtle soup strategy, you can find these fake breakups or fake breakdowns, okay? Now how to use this strategy? So in this strategy again, you have to draw this vertical lines, okay? At the end of the day, like this was Wednesday, so you have to draw a vertical line at 12 a.m. like this, New York time, okay? And in this strategy, we will use the SMT divergences, okay? I have already told you in the start that we will be using SMT divergence in the most of the strategies. So you even in this strategy, we will use it, okay? So you will draw this line in the euro and in the GBP as well. Now what you have to do in this strategy is that you have to wait for the previous day sweep of the lows or sweep of the highs. In this case here you can see it's sweeping the lows, okay? And let's see what happens on GBP. You can see GBP has also swept these lows. So in some cases what happens is one of the pair sweeps the lows and the other don't, and then you get a divergence and then it pumps, okay? And in some cases like this one, both of them takes the sell side liquidity and sweeps the previous day low. But then after the sweep, you get the desired structure. Now we will discuss what's the structure that we are looking for. So you can see that in euro, once the sweep happened, then it didn't make a lower low, okay? You can see that the price didn't sweep this low, okay? This was the low which swept the previous day low, and now this low on the euro hasn't been swept. But if you look at the GBP, this was the low which swept the previous day low, but you can see that this low was swept. So what we got? We got an SMT divergence, a bullish SMT divergence. You can see this one, okay? Now you got this sweep, you got this SMT divergence. What's the next step? So the next step is AutoBlock. As I told you in the start, AutoBlock is also important and we will be using it in most of the strategies. Now that you got the divergence and you got the sweep, you have to look for the AutoBlock. So these are three steps. First, you have to wait for a sweep, then you have to wait for a divergence, and finally you have to look for the AutoBlocks. So anything below this line, any order block below this line will be a valid order block. So this is a 5-minute time frame. You can find these order blocks on the 15 minutes, which are usually more valid and gives a high probability trade, okay? But here we will discuss this 5-minute order block. You can see this one, okay? This was a down closing candle, a bearish candle, and then the next candle closed above it. And let me remove this arrow. You can see that the next candle closed above it and didn't go below this previous candle. You can see it didn't go below this, okay, and it closed above it. So as I said earlier in this lecture, once you get an order block, what you have to do is you have to wait for the price to go down towards the 0.5 fib level of this candle or to the top of this candle. So here you can see that the price came down to almost the 0.5 of this candle. That's your entry point. Your stop loss will be here, or if you wanna stay safe or you don't want your stop loss to get hit, you can put your stop loss here, but I usually put it here, the swing low before this auto block. So you can see it gives you a pump. Okay, so this was the bullish case. There will be also bearish cases. Let me find one. Okay, so in bearish cases we will discuss this one. Let me draw that vertical line at the 12 a.m. So now this is the previous day high. You can see that on the next day it swept this high. Now we'll look at GBP. You can see that GBP also swept this high. Now what's next? You got the sweep, so the next step is the divergence. So is there any divergence? So you can see that here it made a high after this, and you can see that this high got swept. Now in GBP you can see didn't made a high, and these highs were not swept. So again you got the divergence. Now what's the next step? The next step is the auto block. There will be an auto block. There is no auto block on the 5 minute. Let me check it on the 15 minutes or the 30 minutes. Okay, so here you can see that there is that auto block on the 30 minute. You can see the bullish candle, then the next candle closed below it, then the price went up. So as I told you, it will either dump from the bottom of this candle or 0.5 fib level. In this case it went up to the bottom of this candle, okay, and then it came down. So again your stop loss will be just above the swing high. Your entry will be here, and boom, you got this big dump. And I actually took this trade. I was waiting for this bearish divergence. I got that. Then I was waiting for this auto block. I got that, and you can see it works. Okay, so now why is it called the turtle soup? Because you can see here that let me shift to the 5 minute again. I will explain why it is called the turtle soup. So here you can see that some people confuses it with the market structure shift or the break of structure. Okay, they think the break of structure has happened and the price will continue to go upward. Okay, but you can see that there was a divergence. So here the turtle is souped. The turtle are the retail traders, okay, and the noob traders. They think the market structure has broken or the break of structure has happened and the price will go up, but it turns out that it has gone down. Okay, so here the turtle or the retail traders or the noob traders are all souped and the price goes down. That's why it is called the turtle soup strategy. So this was all about this strategy. If you have any questions relating to it, and I personally use this strategy. Okay, this is the most profitable strategy you will ever come around. Okay, the win rate is almost over 80%. You will be amazed to see the results if you master this strategy. Okay, so now we will discuss another famous strategy of the ICT, which is the fair value gap trading strategy. And just like the silver bullet strategy, it's also making people lose their money because again they don't know how to trade it. I will show you some example of how people lose their money. You can see here that the price is going up and there is a fair value gap. Okay, so what people do is they put their orders in this fair value gap because they think that the price will come down to this fair value gap and then it will pump. But you can see it came down, okay, and then it started pumping. So in this lecture I will explain which fair value gaps are valid to be traded, like which fair value gaps you can use for long orders and which fair value gaps you can use for short orders. Okay, so again we will be using the concept of SMT correlated pairs. Okay, we will use the correlated pairs, and then we will understand if the fair value gap is valid for a pump or for a dump. Okay, now again, this is euro, its correlated pair is the GBP. Now you can see that this is a fair value gap. Okay, and it came down. Okay, and it didn't pump from here, so turns out that it's not a valid fair value gap. Now I will show you an example of the valid fair value gap, so that way you will understand, okay, which one is valid and which one isn't. Here you can see that the price is going down. Okay, one fair value gap is this one, but you can see that it got filled in both the GBP and the euro, so you don't have to long here, okay, because both of them filled it. Now another fair value gap is this one. You can see that the euro filled this gap. I will draw it. See, euro filled this gap also. This gap was filled. Now if you look at the GBP filled this gap. Okay, now the second fair value gap, this was the fair value gap, GBP also filled it. So both of them are not valid fair value gaps because both euro and GBP filled it. Now you can see this one, this fair value gap, it got filled where the price came down to this fair value gap, and if you look at the GBP, the price didn't come down. So if you are looking for longs and you see something like this, you see that on 4 hour one fair value gap on the euro has got filled and it hasn't got filled on the GBP. So it means that the price has just come down to take some stop losses, to take some liquidity, and it will go up, and you can see how quickly it pumps from here. Okay, so now you know that in bullish cases which fair value gaps are the most valid fair value gaps. Now I will show you another example. Okay, the bearish case. Now you can see this fair value gap. Okay, you can see that the fair value gap didn't got filled in euro. Now if you look at the same fair value gap here in the GBP, it got filled, so you can see that the price came down from here. So this way you can trade the fair value gaps to perfection. Okay, like only those fair value gaps will be valid, okay, which are filled in one pair and not in the other, both in a bullish case and in the bearish case. Okay, so you don't have to stress yourself. Now I will show you another example. This is the fair value gap. Okay, it didn't get filled. Now if you look at this fair value gap here, it got filled. Okay, the price went up into this fair value gap, so again it's a valid fair value gap. The price came down from here, again it got filled and it didn't get filled, so again the price came down. So you can use this strategy for your fair value gaps, and you can trade to perfection with this strategy. You don't just have to find a fair value gap and long it or short it. You have to look for the fair value gaps on the SMT pair. That way you can trade profitably. Okay, so the last but not the least is PO3 trading strategy, also called the power of 3 or accumulation manipulation distribution AMD trading strategy. This is a pretty much important strategy, and most of the ICT traders, they use it, okay, in their day trading or their swing trades, but they don't know how to use it. Again, they lose their money using this strategy, because what they do is they just find a manipulation. Okay, so first we will discuss what is manipulation, accumulation. So the accumulation is this one. Okay, you can see that in accumulation the price goes up down, okay, and usually you get three taps. Okay, three taps of the upside and three taps of the downside. Okay, so in accumulation we get this three-tap structure. It's not necessarily should be three, but usually you get three taps. Then after the accumulation, there is the manipulation phase. So it can either be towards the upside. So this will be a bearish case, okay? Like the price will go up into the manipulation, and then from there we will see the distribution and the price will go down, okay? So this is the PO3, this is the accumulation, this one is the manipulation, this is called the distribution. Now why is it called the manipulation? This is also called the turtle soup because people think, the retail traders or the noob traders, they think the market structure has got broken and they long around here, okay, and their stop loss is usually here, and suddenly the price starts going down, they hit the stop loss and you can see it comes down below these lows, okay. So this was the bearish case. In the bullish case, what happens is you get the manipulation to the downside, okay. The price goes down, and then in distribution it goes up. So this is called the AMD or the PO3 trading strategy. But everyone knows that the main thing in this strategy is knowing which manipulation is valid or which one isn't. So here you can see this is not a valid manipulation. Like we see this is the accumulation, the price then enters into the manipulation, but you can see that it goes down. Let me draw it correctly, like the accumulation should be this one. You can see this one, okay, the three tap. Now you got this manipulation to the downside, but some traders will get stopped out, but the ICT traders, what they do is they tend to long here and they think the next will be distribution and it starts going down. So I will explain why this isn't a valid PO3, but before that I will explain the valid one and then we will come towards this one. Here you can see that the price is again consolidating here, okay. Consolidation or the accumulation. Accumulation is also called the consolidation. So the price is going up, down, okay. The accumulation can also be in this diagonal position, okay. You can see like this, okay. So three taps, okay, three taps to the upside, three taps to the downside. Then the market moves into the manipulation. So how would you know if this manipulation is valid or if the price will keep going up? So for that, again, you have to use the SMT pair. So the SMT pair of the euro is GBP. Here you can see that the same accumulation or the consolidation has happened here. But then what happens? The euro enters into the manipulation, but you can see there is no accumulation in the GBP. So that's how you know if a manipulation is valid. This is valid because the price has just gone up to hit some stop losses, to take the buy side liquidity. Then you get this auto block and the price starts going down. So due to this SMT divergences, you know that this PO3 is valid. Here you can see this is the consolidation, okay, or the accumulation. Also there is this accumulation. Now the manipulation happens for both of them, okay. So in such cases I don't enter into these longs because both there is no SMT divergence and both have done their manipulation, and you can see the price starts going down. So the confirmation for the PO3 will be the SMT divergence at this manipulation zone. If there is a divergence like this, you can see the price has made a higher high and the price hasn't made a higher high. If you see such divergences in the manipulation, then it's a valid PO3 and you can short it, okay. So that's all about the PO3 or the AMD strategy. Still, if you have any questions, you can ask me. And that's the end of our lecture. I have done my best. I hope it's clear, everything is clear. Still, if I'm missing something, you can let me know in the comments and I will make a separate lecture about those things. And I will make a playlist. So if I am missing something, I will upload separate lectures about it. Okay. Thank you guys.